John and Sue came to us when they were looking to build their retirement plan, and they had some really specific objectives. Two of the objectives that they had is they wanted to decrease how much they were going to pay taxes, on the majority of their retirement savings, which, Chawn, with most retirees, pre-retirees, the vast majority of their savings is in their pre-tax IRA. So John and Sue were no different. They want to decrease how much money they pay in taxes when they take money out of their IRA, and they have a really specific legacy ambition. They want to make sure they can leave as much as they can for the least amount of cost to their children from a legacy standpoint. So as we're going through John and Sue's plan and we're building out their plan, we kept those specific objectives in mind. John and Sue feel like we're in a low tax rate environment, like most people, and like most people, they feel like tax rates are going to increase. So with their strategy in their plan, we identified there's $350,000 of their retirement savings they don't need for themselves. For their retirement vision, for their retirement lifestyle, there's $350,000 that they don't need to live on over the course of their retirement. So what we did with this strategy is we took $350,000 and we converted it into a lifetime monthly income of about $1,470 a month. So they're receiving that $1,470 a month every single month for as long as one of them is alive. Now, it's important to note when they take the $1,470 a month, that is taxable because it's coming from their IRA they've never paid taxes on before. They will pay taxes on that money. But you'll notice because they're taking that money out every single month, it turns into about $16,000, $17,000 a year that is taxable in that year, as opposed to taking the full $350,000 out in 1 year where it shoots their tax rate way up. They're spreading their tax liability up to keep their tax rates at a reasonable level. So they're receiving the income of the $1,470 a month, and now it's a matter of how do they take that $1,470 a month and magnify what they're trying to do from a legacy standpoint.
And as we focus on that tax minimization within the plan, we have yet to meet a family that doesn't want to achieve that tax minimization. All of our families, they're all fine. You all agree that you want to pay your fair share, but when you look comprehensively at the entire plan, we all often stress it's not about what you have saved in total, it's about what you get to keep and what you get to spend. And when you achieve that tax minimization, that puts you in a position where you do get to keep more of it and send less of it to the IRS. So for John and Sue, they are able to take that $1,470 per month. They go obtain a second to die universal life insurance policy. Now, something to emphasize here. The reason we look at the second to die life insurance policy, when you insure 2 lives, that lowers your cost of insurance. So what that does for John and Sue is allows them to get the maximum life insurance death benefit with the $1,470 per month that they're allocating to this strategy. With that second to die life insurance policy, they are able to obtain a life insurance death benefit of $1.5 million. As part of the overall comprehensive planning that we've done, they've identified that that goal is to maximize, as you talked about, maximize that legacy and what they're able to leave behind for their beneficiaries and charities. In the overall context of this strategy, what John and Sue were able to do is take that $350,000 of pre-tax retirement savings and turn it into a $1.5 million tax-free death benefit.
Yeah, so what John and Sue did here is they identified $350,000 that they didn't need to support their lifestyle. They minimize the amount of tax that they pay on that $350,000, and they magnify the amount of money that they can leave on a tax-free basis to their kids. So they turn $350,000, minimize taxes, turn it to $1.5 million tax-free legacy. What this strategy is called is the IRA relocation strategy. Now, John and Sue, the names are hypothetical, the numbers are hypothetical, but since January 1st of 2020, Chawn, we've implemented this strategy many times with our families. What happened January 1st of 2020 was the Secure Act, and the Secure Act completely changed many people's legacy strategies, so we had to get creative. And this is one of the creative strategies that we developed in light of that Secure Act. Prior to the Secure Act, John and Sue could have passed on their IRA And then their kids could have taken distributions out over the course of their lifetime to spread out that tax liability. Post the Secure Act, now their kids, any money they receive from the IRA, they have to have liquidated within a 10-year period of time, bunching up their distributions and increasing, most likely, the tax bill that they have on those distributions.
And we talk so often about having that comprehensive retirement plan, how it's never finished. It continues, we continue to manage it. It grows with you throughout your retirement journey. It's interesting how the Secure Act seemed like it was really hot. It was top of the news for maybe only a few months. Well, what happened? We had the COVID pandemic, and the Secure Act simply seemed, from our standpoint, to maybe go away and fall down that list of concerns. We know there's legislative changes all the time. We have to be aware of that as we work with our families to manage that plan. So yes, the Secure Act has had impacts on that legacy planning. It's requiring families to obtain that information, maybe become aware of these new strategies. What can you do with your assets? How can you be as efficient as possible to achieve these different strategies and accomplish the goals that you have set out for your comprehensive retirement plan?
And through the implementation of this strategy, John and Sue have realized how all of these different guiding principles, the 5 guiding principles, are correlated together. Because within just this one IRA relocation strategy, first we had to identify here's how much they need from an income standpoint, not only at point of retirement, but also 10, 15, 20 years down the road, to be able to determine this is $350,000, this is a piece of their portfolio they don't need to support their lifestyle. So that's the income piece of it. The tax planning piece is how we mitigate the impact of taxation on the $350,000 that they don't need. And then the legacy planning piece of it is how we impact in a meaningful way how they can balloon, how they can really enhance the amount that they send to their kids. So all of these principles are very interrelated as we build out the plan. Thank you for watching this clip of Retiring Today, and don't forget to subscribe. If you have questions about your retirement plan, take advantage of the complimentary 15-minute retirement checkup phone call.